But let's go across. We have a special guest in conversation with my colleague Nilesh Shah, MD and CEO Envision Capital in the house.
So what we think is that the macros have tremendous scope for improvement. But what the markets are probably factoring in right now is basically the improvement in our growth rates. Clearly believe that the GDP is all set to accelerate going forward. And corporate earnings will even accelerate even at a much faster pace. And that perhaps explains why the market still continues to kind of trade closer to the all-time highs and are not significantly corrected.
Nilesh, every year when we start the financial year, we start with an underlying assumption that ये साल different होगा, earnings would be in double digit, and this time around also it's no different.
Right.
The Morgan Stanley estimates for FY19 are that we will not see an acceleration, but we will see a huge acceleration in the aggregate numbers, and the number is about 15 to 17%. Is that a realistic number, or this time around again the optimists will get it wrong?
Well, 15 to 17% I think is a realistic number. I wouldn't be surprised if 15% ends up being a base case scenario. And there are a few reasons for that. First of all, earnings are strongly correlated to a stronger dollar and to a stronger crude oil. And assuming that this situation lasts for a quarter or two, we can expect a pretty strong first half. Number two is that the base effect itself is low. FY17 was one of the most tepid years from an earnings point of view, so the base itself is low. Third, FY19 is going to be the first year of full implementation of GST. So all the benefits of the implementation of GST and some bit of the hit which demonetization had, you will really see those that pain or the losses getting recouped. And fourth, I think the public investment in infrastructure is going to pick up pretty strong momentum. I think just one data point that if road construction activity, we end the last financial year at 23-24 kilometers of road construction a day, and the aspiration for next year is 45 kilometers a day. What it does to the core sectors, the core economy, I think is significant. So I'd probably say that because of these 3-4 reasons makes us very sanguine on a double-digit earnings growth for FY19.
So what does that mean for the Nifty? Do you think we have the top and also the bottom in place? Because there is good news and there is bad news. 2017 in a sense has spoilt us.
Yes.
Because we got a linear move.
Right.
And 2018 has been full of volatility.
Right.
And depending on whom you're asking, you're getting a different market interpretation.
Right. Well, it looks like that the bottom is in place for the Nifty. Okay, it's quite possible that we may again, because of global events, we could again kind of break 10,000 and go on to retest a number below 10,000. But I don't think it's going to be substantially below 10,000. You could have 200, 300 points away from 10,000, and that's where I would think the bottom would be in place. I surely don't think that the top is in place. The best is yet to come for the Nifty, the best is yet to come for the markets, and that's going to be powered by a solid earnings growth, which we have not seen for the last 7 or 8 years. It's been almost a decade that we've not stepped into a double-digit earnings growth, and that's where I think the tailwinds for the markets are going to come from. So our sense is that we're going to see substantially higher levels for the Nifty, maybe in the next 12 to 18 months.
What do you make of TCS numbers? Because if I blend TCS, Infosys and Wipro numbers, the picture is very divided. If you're a Wipro shareholder, nah. If you're a TCS shareholder, great. So IT is no longer this synchronized trade.
Right.
It's very divided between the IT space. I mean, when we started our career, we used to speak about banking in one breath. Then we started talking about private banks and PSU banks.
Right.
Now within private banks also, we're talking about corporate banks and wholesale banks.
Yes, so if I were to kind of look at the top 3 players in IT, I'd probably still say maybe, I still think that they've not yet been able to kind of get back the business momentum. Stock prices have done well, and that's partly because a lot of them have done cash buybacks, which has helped them to return cash to shareholders, which has improved things like return on equity. But the business is yet not growing in double digits. But I think what is really aiding earnings as well as the stock price is basically the strength in the dollar. From 64 to 67, that $3, which is basically 5%, virtually flows straight to the bottom line. Of course, you've got to minus on-site expenses and all of that and cross-currency movements, but that straight away adds, and that's really helping their earnings kind of do a lot better versus the business growth. So still, I think the business growth doesn't look as great, but the bottom line growth is getting aided by a strong depreciation of the rupee. On the other hand, I think the tier 2 companies in IT space are showing better promise, better potential, and are demonstrating better growth rates. And that's because of the power of focus, their ability to focus on a segment, their ability to kind of, snatch away one or two big customers from the big boys and provide them solutions, I think is helping them to grow at a faster pace. And I believe that trend should sustain. So at some point of time, I'd probably be more biased towards the tier 2 mid-cap IT space versus the established top 3 players.
Again, within mid-cap IT also the street is getting divided. Mindtree, great set of numbers, but can't see the same about Persistent, which in a sense has been zigzagged with their commentary and with their delivery.
Yes.
So what are the 2-3 factors you would look at when you are looking at buying into IT stocks?
Well, I think the first thing that you need to really look at in the case of IT stock is what is the segment that they are really focused on. That I think is very, very important. Are they into the conventional, traditional stuff, or they basically are into the new age businesses? I mean, of course, digital was new age 2 years back. Today, today digital is basically the mainstay of companies. But I think within that, there are different segments so I think one is to really say, what is the vertical, what is the domain, what is the business segment that this specific company is focusing on. So that's, I think, one. And the second important part of it basically is that, does this company have any kind of pricing power? Is it able to kind of get a better bang for the buck? Is it kind of able to get better dollars for every hour that any of its employees spends? Or is it kind of going more towards automation and things of that kind, which will improve productivity and therefore realize? So I think that's the second thing that too. And third, of course, is that, is this company spending money on acquisitions, or is this company spending money on buybacks? I think acquisitions have not necessarily worked for IT companies. I mean, I think that's the big difference between TCS and Infosys today. That TCS actually spend a lot of money on buybacks, Infosys spend a lot of money on acquisitions under the erstwhile CEO.
Even Wipro, the string of pearls. Every 6 months they were acquiring a company.
So I think I think the street is telling us that look at the price performance of TCS versus the price performance of Infosys and Wipro. And I think the same applies for mid-cap companies. I think you have to be very careful when a mid-cap company goes out and does some acquisition. I think that should itself be the starting point of a question mark. So
you will not buy a mid-cap company when they're acquiring companies?
I wouldn't say I wouldn't bond, but I would be very careful of the price that they're paying. Is this kind of complementary or not? And is it kind of stretching it? Is the balance sheet going to get stretched because of this acquisition or not? So I'd be very, very cagey and very, if a mid-cap company just goes and does an acquisition for the sake of doing an acquisition.
Which could be the next Tata Legacy for Nilesh Shah and Envision?
Well, tough, but I think, we've been owning Persistent for some time now, okay? 5 years, the first couple of years turned out to be very good. The last 2 or 3 years have not been very good. But we clearly believe that the worst is behind for Persistent. We clearly believe that. We saw the digital revenues growing at 30%, and we think that it's probably today the most reasonably priced mid-cap IT companies. I mean, a lot of IT companies have kind of gone through the roof, whereas Persistent is honestly there where it was. And we clearly think that from a pure stock price, it has a reasonable upside potential.
What should one expect in terms of returns from the classics now? HUL, Titan, I can throw in an Avenue Supermart. These are good businesses run by efficient managers. But P multiples are something which at least I have not seen in my career, which is not a very big career.
Right.
But in my 15, 17-year-old career, P multiple of 70, 80, even 90 times for stocks like Avenue Supermart.
Yeah. Yeah, so I think, the valuations are crazy, like what you rightly pointed out. At these valuations, I'm not quite sure if there are returns to be significant.
Who's buying these stocks, Nilesh?
I think institutional investors who are benchmark, who run ETFs, or who have large pools of capital to be deployed, and you just kind of deploy it saying that, okay, fine, if India grows at a particular X rate, then an HUL or a Titan will surely at least grow at that rate, which I think should be satisfactory for them. I mean, if you kind of take a situation where the economy grows at 8% in real terms, add 5% inflation, so if they can kind of look at companies which are growing at north of 10%, I think it satisfies them from a purely ability to deploy large pools of capital. So I think that's really the segment which is basically. I think for investors who are looking out for bottom-up returns going forward, clearly I think consumer staples is not a great place to be in, especially given where the valuations are and where now they're dealing with saturated markets. I think the markets for soap, shampoos, etc. are reasonably mature. These are reasonably saturated.
Mature businesses.
These are mature businesses. But kind of look aside, and I think if we're talking of in India growing at a fast pace, if we're talking of an aspirational India, a middle class which is burgeoning, my sense is consumer discretionary is the place to be. And I think that's clearly where the big opportunity is. And therefore,
define consumer discretionary
so
products.
for example, where you don't need to consume it on a day-on-day basis, but where you probably consume it, say, once in a year, or once in 3-4 years or 5 years. So obviously, of course, say consumer appliances is one area, but valuations are a little heady there. But the other big area that we see is travel, tourism, hospitality. I think the way Indians are holidaying, the way Indian families want to kind of holiday more regularly, more frequently, I think just increases the size of this industry and the potential. And there are very few quality players in this segment. And I think there's a huge scope for those quality players to get significantly re-rated over the next 3 to 5 years. So
there
I think
are two listed companies I can think of, Cox and Kings and Thomas Cook. The challenge for them, Nilesh, could be that they are not businesses which are monopoly in nature.
Right.
There is no moat around them.
Yes.
I can go on a website and perhaps get lured by another website which is giving me better returns.
Right.
You're a classic investor. You like to buy monopolies.
Sure.
It may not be consumer monopolies, but it could be talent monopoly, it could be a service monopoly.
Yes.
What is the monopoly for some of these companies?
I think, see, at the same time, when I think a lot of Indian families yet, okay, still are stuck to the offline model. Okay, I mean, online will gain momentum, but yes, this will gain momentum many years down the line. And these kind of companies are also creating an online presence. It's not that they are not into online. So, but I think when an Indian family plans, including myself, when we plan a holiday, we don't necessarily do everything online. Okay, we probably look at airfares online. We look at the cost of hotel stay online, but then there's everything else. The local stuff out there, the destination management out there. We need to do a lot of stuff at those specific destinations, and that's really where the big margins are. Okay, so that's one, I would say, a market imperfection or a market inefficiency which is still there in this business. And even if this industry grows at 15-20% and these kind of companies being market leaders can sustain that kind of a growth rate, I think it is fantastic. I think the kind of cash flow generation which can happen, I think can be phenomenal. And the value, I still think there's a lot of upside left.
I'm surprised this kind of an comment is coming from someone who has a 18-year-old son, because your son must be making the itinerary rather than you telling him where to go now.
Yes, I think you're completely right. But I still think that it's not that you can plan 100% on your own, because I think the quest is now to go for exotic locations. And
life is changing.
Life is changing.
Okay. So I'm going to put this graphic out and it will just come up on the screen, and let's call it Nilesh Shah's checklist, and we'll make 3 checklists. When you buy a stock, what are the 3 things you look at?
Well, I think the first thing to really look for is basically the size of the opportunity that this company is addressing. So is the runway long enough for this company? Okay, which means that can you really see this company growing for the next 5 years and maybe even beyond? I think that's one important thing, and therefore it boils down to basically what is the growth potential for this company. Number 2 is that with this growth, will it be able to generate cash flows? Will it remain a capital efficient company, and therefore will it be able to generate a return on equity or a return on capital above at least a basic threshold level?
What is your benchmark?
I think broadly we be comfortable with the mid-teens kind of a number. We're saying is if a company can kind of grow in mid-teens, and if it can kind of generate a return on capital of at least a mid-teens kind of a range, then obviously that's a useful starting point. We're not saying therefore any company which, for example, has a particular mid-teen ROE, you go and invest in it, but these are all starting, I would say, filters out there. So that's basically the second thing. And the third, of course, is that does this have exemplary leadership? We've figured out over a period of time, and that's been our learning experience, that leadership makes a very, very big difference even in a vanilla business. And we've seen this in, say, for example, private sector banking or banking in general, private versus PSUs, and within private, we've seen it, how leadership makes a very big difference. So I clearly think that I'd probably say that these are the 3 important filters that one would want to kind of look at.